Hello, Jim here. You can make some crazy income selling options. Today I want to share with you a couple of tricks that I use, and I also want to share with you my trades from last week. So stay tuned to the very end. I think it's going to be well worth your while. Let's go ahead and jump right in. I don't really have much to say about the market. I do believe it was kind of a shocker last week when the Fed surprised us all related to the cuts that they're going to do this year. They did say they're going to continue to do 3 cuts this year before the end of the year, which really surprised the market. And we've been kind of in an uptrend since then. Do I think that they're really going to hold true to that? I'm not so sure. I mean, a lot of the stuff out there in the market, in the economy, points to higher inflation. So I'm not so sure. I don't know if they're being pushed politically or why they might have made those kind of comments, but I personally think they're going to stay higher for longer. I could be completely wrong. At least, that's my 2 cents. I think a cut at this point would probably cause inflation to go through the roof. Of course, it is an election year, so politics could get involved, and I wouldn't be surprised if they do. I believe both parties want a cut in rates. So that being said, let's jump right in. Now, I like to start off most of my videos or all my videos talking about what's most important when you're selling options. It's true of investing in general. You need to pick the right companies. And I like to reiterate this in every video. I look at a couple key criteria. The first being, is the company making money? I don't trade in companies that don't make money. So if you follow me or you're in my memberships, you'll notice, people ask me questions about specific companies that may not be making money, and I typically give them the same feedback. I don't trade in them until they are making money. Now, if they're close to making money, then I will add them to my watch list, and I'll keep an eye on them. And that's happened with a lot of companies. I've had Palantir on my watch list for quite a long time, and even Path and a few other companies that really didn't make money for quite a while, and just recently have been making good money and increasing their income nicely. So that's the second criteria, year over year earnings. How is their performance? Are they growing? Are they a healthy company? The other important criteria is debt. How much debt do they have? I prefer companies with no debt or very little debt. The mistakes I've made in the past a lot relate to debt. I did not take it serious enough that some of these companies were using too much debt, or they're not profitable. There's a lot of companies that may not have a lot of debt, but they may be issuing lots and lots of shares, and their profitability may not be good. So that's the next most important part to me, is find companies with really good profitability. Return on investment, return on capital, return on equity. What do their margins look like? And then also, earnings per share. What is their earnings per share? I also prefer companies that aren't way overpriced. I typically prefer to trade in companies that are less than 150, and in most cases less than 100. I don't trade in like NVIDIA and really, really expensive companies, because I do feel when we do have a correction, those companies can correct by 20 or 30%, which can be hundreds of dollars. So I just like to reiterate that every time. If you win with picking the right companies, everything else kind of falls in place. Now, the next most important piece is picking the right expirations and the right delta. I like to go farther out. I try not to go past 90 days, especially with puts. Some people like to do weekly. Some people like to do monthly. The reason I like to go farther out is, as you go farther out, you can typically pick a lower strike. So if it's a $100 stock currently, if you do a weekly expiration and say it's a 20 delta, well, that may be a 95 strike. You go out a month, that may be a 90 strike. You go out 3 months, that may be an $80 strike. So it's just less risky, and I prefer less risk. And I typically, for puts, I'll do like a 15 delta if it's for an account that's pretty much invested, that I'm not really worried about owning the stock. Maybe I'm just trying to make money. Again, even though I may be doing that, I'm still picking companies I'm okay with owning. But again, sometimes you do change your mind. So another important point is to kind of review, has anything changed with that company, especially if you're looking at rolling or making a change with it. Just be sure nothing has changed. So I do around a 15 delta in that case for puts. I'll go with a higher delta, 30 or 40 if I'm running the wheel. Like in my IRA at Fidelity, I have lots of cash. I've only had, I believe, Corning get assigned. So I'm perfectly okay with owning specific stocks. So I'm willing to take a bit more risk. So I'll do 30, 35 delta. I've gone as high as 40 delta, especially if it's a company that's not overpriced. For example, Zoom has been right around $65 for the last several months. It'll get up to 70, then it'll drop close to 60, but it's stayed in that range and it's not really overpriced. So I'm okay with selling puts on Zoom at around 65 or 62.50 or 60, depending on how much it's down that day and how the premiums look. So especially if it's a bargain stock, meaning it's not overpriced, it's a little bit easier to take a little bit more risk with selling puts. Now, one strategy I do with running the wheel, a lot of times I'll start with a cash secured put. And if I have really good premium, I'll look at the $10 out. Can I purchase that put $10 out inexpensively and protect myself from the downside? A lot of cases I find for 15, $10, $15, $20, sometimes $2 or $3, I'll buy that put and protect myself on the downside, even though I'm running the wheel, which, protects you if there is like a black swan event and the market dives 10, 20, 30%. And I've actually played with the idea of also doing that with covered calls, because a lot of times, I'll sell a covered call in the stock, especially if it's a company that has okay growth and maybe not great growth. It may shoot above that covered call. So I played with the idea of buying a call, just like I am with cash secured puts. So if it does shoot through the roof, the only risk I have is the spread. Give you an example. Say it's a $50 stock. I sell a covered call at 55. It shoots up to 60. But if I had purchased that call, again, inexpensively, then I can pick it back up at 60, and maybe over the next 6 months, it goes up to 70. So it's something I'm considering. I haven't currently done that, but it kind of makes sense with some of my stocks recently, like Square shot through the roof, Palantir shot through the roof. So something I'm playing with doing. Now, in relation to the puts and the calls, one of the key things to keep in mind is when you're looking at it in your brokerage, and I like to call this realized gain confusion. So you'll see an area in typically the position page, which will show your profit or loss. And that's based on the bid and ask for closing that particular position down the road. I'll get a lot of questions from people that are panicking. Oh, should I close? It's showing a $400 loss. And they a lot of times will close and lock in that loss. And even though it may show a $400 loss, it may not be in the money. It may be, if it's in the money, it may be close to the money. And I found that if you really are patient, a lot of times it'll dip into the money and come out, dip in, come out. And in a lot of cases, that's being patient and waiting and not panicking. I've been able to get out of positions if I didn't want to own the stock. So that's one thing just to keep in mind. Don't panic. Stock will move around. And again, that realized gain confusion, being that bid and ask, sometimes can be way out of whack, meaning someone may put a huge ask for the, to purchase or that call or put, and the pricing may be really high, showing you a bigger loss when actually it isn't much of a loss. I've seen like $400 losses in that position for that realized gain when the strikes, is way far away. It's still way out of the money, but it's showing as a huge potential loss. So just keep that in mind. Try not to panic when you see that negative number. I've had that discussion with 2 or 3 members this week. And, I had to reiterate for them, just be patient. The stock will probably come up. This is a good company, and they're just unusually low at this point. And that kind of leads me into another point I wanted to make. I do have memberships. I do have a lot of people joining. Details will be in the description. I'm one of the only YouTubers that has where you can try the two of the memberships for free. The third one is coaching, and I've had some people join, and I originally had it for free and they never showed up for the coaching session. And I'm a consultant, so I have billable time with clients, so I can't really afford to do that. So that is no longer where it has, a free period at the beginning. But I have two other memberships that are free. One gives you more access to Discord, gives you group meetings that we have every other week that you can get access to. And then all sorts of information, all my trades going back 3 years, all my spreadsheets, and lots more details that are in my collections. So if it may be worth your time to take a look. And as always, please subscribe, hit that like button. It does really help the channel. Now, another important point related to what I was talking about a minute ago is you really need to have an assignment strategy. In cases where I've been assigned, in some cases, it's worked out really well. I'm glad I was assigned and the stock continued to go up and the appreciation on it was really, really good. Other times, I get into kind of a rolling frenzy, which in actuality, it would have been better to not roll and to let it get assigned because that stock later on becomes a lot pricier. One of the key examples is Williams-Sonoma. I rolled out of owning it, and now I think it's doubled in price in the last 6 months. So just keep that in mind. Come up with a strategy. In some cases, doing nothing is the best choice, letting it get assigned, not avoiding that assignment, because again, the appreciation in a particular stock could be a lot more down the road, especially if you're dealing with growth companies like Palantir or Path, or even in Zoom. A lot of people don't think Zoom's a growth company, but if you look at how they've done, and they overperform, meaning their projections are really low, but they always beat them considerably. So if you look at if they continue to beat them the way they have, they are truly a growth company. And I like them. They have no debt, and they do a nice job managing their systems and the company in general. So that's the main key points I wanted to share. I next want to jump into my trades from last week, and I'll have a couple more tidbits and talk about some of the same things I talked about in the beginning of this video. So stay tuned. Let's jump into the next part of the video. I've opened up my planning worksheet from last week. Every week I provide these to my membership, typically in the morning on Sunday, sometimes in the afternoon if I have stuff going on. It takes me a little bit longer. I think the latest I ever got this to the membership was Monday morning. But typically it's Sunday. So I go through all my accounts, and I have 4 different accounts that I trade in, 2 at Fidelity, 2 at Schwab. And I literally go through all my trades. Anything expiring within the next 2 to 3 weeks, I'll list it here. And that way I have one central place I can work with. And then as I make my trades, I'll note, that I made a trade. I did something different to the particular trade if it was already listed. And that's what you're seeing with the green highlighting. So I'm not going to go through the other ones that are just here, just the monitor. I'm going to go through the ones I did do trades on. So the first one is ACLS. This is a chip maker. It's more related to the EV market. So it's been hit a little bit hard recently. And it's been kind of into the money, or in the money, out of the money, in the money, out of the money. And what I did is I rolled it. This is the second time I rolled it. So originally I believe it was a 120, 110. And then I rolled it down, or it might have been a 115, 105, but I rolled it down and I widened the spread. And that's one strategy I typically do if I'm not 100% sure I want to keep the stock. I still really like ACLS, but at the time I was making this trade, there was some concerns about EVs, and you know, demand was so low for them. But I think EVs are going to come back. I don't know that everyone needs an EV. I don't particularly want an EV. But there are a lot of people, a lot of neighbors who actually own EVs, mostly Teslas, but also other EVs, and they really enjoy them and like them. So I don't know, I may change my mind at some point. So this was originally expiring on April 19th. It was 107.61. So it was in the money when I made this trade again. And I rolled it out to 517 and I kept the strikes. I brought in an extra 324.59, which all the premium I had brought in for that trade up to this point was $784. So the required capital was 3675. That's literally the 4,000 minus the 324, and I had a 57% yearly return. So adjusted for the year, it's like a 57% return. So even though it's been in the money, and I believe this week it's up, it may be like 112 or something like that. So it's currently out of the money at this point. When I made this trade, it was. This next trade was 3M, and I closed this. And just like I was talking about with ACLS, 3M was also in the money pretty deeply at one point. I believe it got down to mid 80s. So I had opened up a vertical put credit spread, 90-80 were the two strikes, expiring on 4/19/24. And at the time it was 105, so it was fairly out of the money. And this one I just closed. So I've had a lot of people ask me, well, are you tracking when you close it? And how do you, the trade's not really finished. Each of these planning worksheets that I do on a weekly basis, I also note in there when I close them. So I spent $16 to close this. So this trade was very profitable. And I actually closed it almost a month before the expiration. So when I've gone back and I've done profitability, on completely closed trades where I'm not rolling them anymore, my profitability was even higher. So that was 3M. This is STY. This is, I mark them yellow if they're in the money. So this is, I don't want to go into a lot of detail, but this is an in the money covered call that I've had a long time. I just keep rolling it. It seems to allow me to roll and make some good premium each time. And my hope is it gets assigned away from me. It's funny, sometimes when I want them assigned away from me, they don't get assigned away from me. But I want to switch from using SDY. I prefer SCHD with its higher dividend, and I know it's a better ETF than SDY, and I'd prefer it. Next is XLE. Again, I closed XLE. It became very profitable. And again, I'm beating a dead horse, but this one also ended up in the money at one point, and now it ended up way out of the money, and I was able to close it. So it was a vertical put credit spread at 77.67, expiring on April 19th. It was, at the time of the trade, 90.83. So quite a bit out of the money, and I closed it for $8. So again, closed it over a month early. And again, going back, I probably have a really good return on that. So next, these were all new trades. So at the top of the spreadsheet, I list all the trades or positions that are coming up over the next 2 to 3 weeks from all my different accounts. But then when I make new trades, I add them at the bottom of the list and usually just note what account they're in. So the first one was Zoom. This was a covered call. I did have 100 shares of Zoom get assigned to me. And actually, I want to own another 100. So I'm either, if Zoom drops down below 65, I may just pick up another 100. But I have 2 other vertical put credit spreads with Zoom. And I think Zoom has probably been one of my most profitable stocks to trade. It really does not move much. Here you can see it's 66.38. And I think today is March 28th. And it's still right around 66.38. I think almost exactly at 66.38. So this covered call was a 70 covered call made March 18th with an expiration of 5/17, so not quite 2 months. And I did it at $70 again, and I brought in $228 in premium, which is pretty good for a covered call. And here's the required capital. That's what the cost basis was of my Zoom. And it's like a 21% return, which is really good. That's really hard to get for covered calls. So Zoom has really good call premium too. So that's another reason, like I said, I only own 100 shares. I'm thinking I want to own 400 shares. Next is Tesla. I've just started recently trading in Tesla again. It's getting to that point where I can sell cash secured puts around the price. I like it around 145 or 150. So this one I did on March 19th. It's in my Fidelity IRA, cash secured put, 145, expiring in 517. So a little less than 2 months, so a little less than 60 days. It was 170 at the time, so it's still pretty far outside the money. And I picked up $427, which is quite good. Here's the required capital. It's just the 14,500 minus the 427, and it's like a 19% yearly return, which again, with the amount of cash I'm able to bring in, if I did this as a vertical put credit spread, it probably would have been more like a 60, 70% return. But again, my goal is to own some Tesla right around 150 is what my hope is, and then I can start selling covered calls, just like Zoom. Tesla has really good covered call premium too, so I would be pretty happy with owning maybe 200 shares at around 15 or 150, 145, something like that. Next is Cisco. I own 400 shares of Cisco. I made this trade on March 20th. It was 57.50, and at the time, the price of Cisco was 49. So this was like a 26 delta, expiring on 6/21. So I did go a little farther out, almost 3 months out. And I typically will go a bit farther out for covered calls. It's sometimes a little bit harder to get good premium, especially on companies that I look at more as value companies. I look at Cisco more as a value company. I also look at Coca-Cola. These are the big blue chip companies that pay dividends and increase the dividends year after year. And they don't move much. Cisco seems to move between like 45 and 55 or 40. Well, right now it's 49. It may get as high as 58, but a lot of times it'll come back into the mid 50s. Actually, this was a roll. So I rolled it out from the original expiration was 6/21, and then I rolled it to 9/20. So I actually rolled a covered call that was already, it became very profitable. Yeah, 79% profitable. So it was 79% profitable. So I decided to lower the strike from 57.50 to 55, and I brought in 302.80 in premium, which is like a 3.25% yearly return, which happens to match almost exactly the yearly dividend for Cisco. So it worked out quite well. And then the last trade was Corning, and just like Cisco, I own 400 shares of Corning. And this, let's see, is this a roll too? This is also a roll. So it was 34, and just like Cisco, to become very profitable. And what I decided to do was to roll it from 117. So this is nearly a leap kind of roll. And I rolled it. Actually, I kept it at the same place. This doesn't make sense though. So it was 34. So I was able to roll it 235. I think I might have this wrong. It may have been. No, that's correct. This is one of the few instances I was actually able to roll it from 34 to 35 and bring in some more premium, which is really unusual. So, and then the yearly return on that was 4.83, which again is more than double the dividend that Corning pays. Actually, I think this number over here is incorrect, this 34. I think that was 36. I think I entered the wrong number, and I brought it down to 35, again, because it became pretty profitable. So I did, let's see, 1, 2, 3, 4, 5 trades, and I closed 2. I don't really count closing trades as is true trade. So I did one trade a day during the week last week, and then I brought in a total of 1773 for the week, which if you come up and you look at my goals up here, my weekly goal is 1600. So I was able to beat my weekly goal. I've had other weekly weeks where I've actually done higher. I think I did a $2,000 week not long ago, a couple weeks ago, that I also did a video on. But again, once I reach that goal, a lot of times I'll kind of lay off worrying about making too many trades. So that's probably why I only did 5 trades last week. I decided, well, I also took Friday off, so I was not able to trade on Friday. So it was kind of a shortened week for me. And then for the month, at the end of last week, I was at 5907. So I was already really close to my monthly goal, which is 6,400. I believe this week I'm right around 7,250. So I kind of blew away my monthly goal. And I did kind of a pretty good mix. I did, what is that? I did mostly covered call. Well, I did mostly covered calls. I did 3 covered calls, a cash secured put, and a vertical put credit spread. Here's the roll. Yeah, so I did kind of a little bit mix of everything and more covered calls than anything else. And that's why I like to reiterate in a lot of these videos. It's good to have both. It's good to have earnings from covered calls and also earnings from puts. It gives you some flexibility, especially when the market shoots up and your puts become very profitable, or if the market dives and your calls become very profitable. When they become very profitable, just like I showed here with the 2 I closed, it allows you to close those and then open better trades down the road. So that's what I wanted to share. If you have any questions or concerns, or think I missed something, please leave a comment. I typically try to answer all my comments, so I hopefully can get to them within 24, 48 hours. And as always, thank you for joining me, and look forward to seeing you next time.